Thanks very much, Mitesh. Those are near-term trading ideas. Siddarth Bhamre is with us, Head of Research at Religare Stock Broking. Siddarth, good to have you back on the program. Thank you very much. We get follow-through, maybe. I mean, at least right now, you look at U.S. equity futures. You look at the dollar. It's all going in the right direction, so as to speak. So maybe more gains ahead. How are you looking at things near-term?
Hi, Prashant. Thanks for having me on your show. Prashant, we have been optimistic on markets since quite some time. And, we have been talking that despite high inflations, despite stronger dollar index, our markets were buy because of the domestic consumption theme. And the way there was too much of pessimism. I think most of the people, if you just look back, a week back or 2 week back and check on, social platforms or your channel, a lot of people would talk about recession. A lot of people would talk about slowdown and how big correction is coming. And I think this is the nature of market that at 18,000 people will talk about 15-20% upside, and at 16,000 they will talk about 13,000, 12,000. We don't, follow that way of predicting markets. We have been optimistic around 16,000 odd levels, 15,500. 18,000 to 18,500, I believe, would be kind of levels where we might see, some respite in this market, or we might see, some supply coming into this market. And why I'm saying that, Prashant, yes, there is a downtick in US inflation, and that is cheering this market. That's the reason dollar index has fallen, and yields are also, correcting a bit. But let's not forget the fact that many economists believe, and we too feel so, that Fed is probably overshooting, and the repercussions of that would be felt once you start seeing the job data coming out. So rather than getting excited by seeing the CPI data, we won't go too optimistic on this market, because when CPI data was not good, we were looking at jobs data and being excited. So now when CPI data is turning favorable, we are just hoping that job data doesn't turns unfavorable, because if that turns unfavorable, then all these gains would be like probably 1 or 2 days gains, and you might see a correction happening. Even if I have to wear my old hat of technicals and see that this market is consolidating since last 1 year, Prashant, and now we are on the upper side of the range where 18,000, 18,500 we have seen supply, around 15,000, 15,500 we have seen buying interest emerging, and these range has been breached on the both sides, and again market has fallen into this range. We are at the upper band of this range, and we won't be too excited about this market, though structurally the domestic consumption story and India is a better place to be. That story remains, but at a price not at any levels.
Siddarth, good hearing your thoughts in, but market, same time last year when we were at 18,000 looked so different in terms of what was driving it, right? There was no inflation concern globally. IT stocks were doing very well. Banks were underperformers. Now, circa 1 year forward, the Nifty is still at the same levels, but the markets have been concerned about inflation through the year. There was a war in Russia, Ukraine, and now banks have taken the front seat while IT stocks have been battered. So same levels, but the market texture, what's driving the market has changed so much in the last 1 year. We need to get into a very short break. We'll come back and continue our conversation with Siddarth, so stay tuned.
Okay, welcome back. So the market is, 7 minutes away from sort of close for the day, close for the week, and it's a super day once again on the index so far. Let me just see what the gains at this rate are going to be for the week. Actually, it's going to be 1 1/3% higher for the week, because we had trouble earlier, especially yesterday with that 2.5% cut that we saw. Well, we spoke with Jahangir Aziz earlier today. He's, of course, the top economist at JP Morgan. And he's actually saying, hold your horses. Don't extrapolate the inflation beat and the consequent market reaction many months into the future. It's just 1 month. So that's some important opinion coming in. Take a listen.
The market clearly reacted to the fact that the core inflation was lower than what was expected. And that sort of reinforced the idea that the door to a step down in Fed rate hike in December would be open. Remember, the Fed said that if the data supports, they would step it down. But one needs to remember in all of this, euphoria, one needs to remember that the non-farm payroll just 2 weeks back was actually stronger than expected. The labor market is slowing, but not slowing as quickly as the Fed would like. I think in the US, clearly we haven't peaked. There's a long way to go. And I think in the case of India, I think the task is much harder. It is very difficult to see that the dollar has actually peaked. Most likely the peak is still ahead of us. We will go through these bumps, but clearly the level of dollar where the dollar can go is the peak of the dollar is still ahead of us. And given the fact that the peak of dollar is ahead of us, and given the fact that, as I pointed out, India does not provide enough amount of compensation for the very significant macro risk, given the size of the current account deficit, size of the fiscal deficit, and the inflation, it is very hard to see that the rupee actually is bottoming out at these levels and starting to appreciate.
That's some